Hey, welcome back to another episode of Insurance Test Help. We are talking about annuities for the life and health insurance exam this week. So we are going to get into what is an annuity. But first, let's look at how much of your exam it makes up. For your life and health, it can make up 6 or 7% of your exam. If you are just doing the life insurance exam, it can be as much as 10%. So not a whole lot of the exam, right? But let's not leave anything on the table. If you're 10% is a lot to just leave laying there. If you're close on the exam, if you've already taken it one time and you missed by a really small percentage, 6 to 7% of the life and health or 10% on just the life is too much to leave on the table. So let's get this one nailed down and get every single annuity question right. So here we go. So the basic concept of an annuity is just like one for all retirement, right? We're putting money into our nest egg for it later on in life. So an annuity is a contract that provides income for a specified number of years or for your entire life. It is a vehicle or a contract with an insurance company for the accumulation of money and then the liquidation of that money or the liquidation of your estate. So think putting money into your piggy bank and then receiving checks later on from the insurance company. Annuities are not life insurance. They're kind of almost the opposite, right? Life insurance happens when you die. You get a nest egg. Annuities are something you build up when you're alive so that you don't run out of money before you die. So just think of it building up little blobs into your piggy bank so that when you're older, you can take money out of your piggy bank. Okay, because it's a contract, there are parties to the contract, right? Like all of our insurance contracts have different parties to them. So the first up is the owner. They control the contract. This does not necessarily have to be the annuitant. Sometimes it's a business. The owner controls almost everything. They have all the rights. They control the contract. They can name and change the beneficiary, select the payout option. They control the pay premium. They control the tax reporting. They fund the annuity. So the owner is really the one in charge. Okay, next up we have the annuitant. This is the person whose life expectancy the annuity is based on. They must be a natural person. I think that will be the test question if you have one on the annuitant. The measuring life used to calculate the income is based on the age and life expectancy of the annuitant, right? So the annuitant has to be a natural person. So you will see that probably as your test question. If you don't see it as that, it might be that the owner doesn't need to be a natural person because the actual owner, the last person we were talking about, can be a business or all kinds of other things that doesn't have to be a natural person. So annuitant, natural person, owner, and all the things on the last one, not necessarily. Beneficiary, we all know what that is from life insurance. Even though annuities are not life insurance, you still have a beneficiary because you're sticking a whole bunch of money in there. So there are still maybe benefits that are owing to a beneficiary, or if you die before you annuitize, that money has to go back to your family in most cases. So you still need to name a beneficiary, and that beneficiary is the person that would receive those funds. So we all know what a beneficiary is you should know from your life insurance part of the exam, but make sure you know what the beneficiary is for an annuity. Insurer, just like anything else, it's just in the insurance company. They issue the contract, invest the funds in this general or separate account, and guarantee certain features depending on the type of annuity it is. This is the insurance company. Okay, let's get into the phases of an annuity. Pretty simple. Annuity has 2 phases: money going in, money coming out. Accumulation, right? Money going in. Annuitization, money coming out. Accumulation is going to be gathering the eggs for the nest egg. Accumulation is the period during which you are making your contributions to the annuity and it is growing. This one should be pretty straightforward. Accumulation is when you're putting money into an annuity. You are accumulating your money. Annuitization is when you're switching You're no longer accumulating. You're now eating your nest eggs, right? It's where you've now switched to now the payments are going to the annuitant. So there's no more accumulating. The retirement nest egg has been, that's it. That's all you're going to accumulate. You're now retired or whatever. And now the periodic payments are being made to the annuitant. I think the one they're going to jam you up on the question is the annuitization phase, because the accumulation phase is just so self-explanatory. So knowing how they love a tricky question, it's going to be the annuitization phase if you see anything on the phases. Okay, fixed annuities. These are the ones you're going to be able to sell with a life license. Fixed annuities, fixed rate of return, right? So just remember fixed equals fixed. So fixed annuity, fixed rate of return. So say 4%, something fixed, fixed payments. So grandma gets a fixed rate of return. She's going to get a nice, she's going to know every month what she's going to get in her check. It's going to be simple for her to remember. There's no ups or downs in her guaranteed payments on what she's going to get every month. Variables, there's going to be all kinds of stuff on your variables. They're going to be on your exam. Remember, anytime you see variable, the investor takes the risk. The variable does not guarantee an interest rate. The investor is going to take the risk. The investment is going to go into this separate account, not the general account. That could be the other question. So the investor takes the risk, the separate account. The other question is going to be that you need the dual licenses. You need your insurance license, but you also need your FINRA securities license to sell them. So there's 3 possible questions for variables on the exam. They love to include it. So those are the possible 3 questions: separate account, FINRA licensing, and investor takes the risk. Just remember those 3. You'll probably nail the variables question. Indexed annuity. Anytime you see indexed, it means it's tied to an index, such as the S&P 500. That means it has a guaranteed minimum interest rate, but they have linked it to an index. So if you see an indexed annuity, that means they have linked it to something like the S&P 500. Okay, there are lots of different ways to fund your annuity. There are single premium. These are for people, well, sometimes they win the lottery, right? Or sometimes somebody dies and you have a insurance, a payout from their life insurance that you want to just put somewhere. So that is one option for a single premium. So let's talk about that one. So a single premium is basically you just make a lump sum premium to the insurance company. Sometimes it's from another life insurance policy because somebody died and you just want to turn it into annuity. Sometimes it's from a lottery winnings. Sometimes it's from a lawsuit, a structured settlement, something like that, where you're just going to make payment. You've sued them and they're going to make you payments, and that will pay an annuity to you, and that is something where it's just a lump sum, and that will make payments to you for the rest of your life. So that is a single unit blobbed into an account, makes little payments to you for the rest of your life. Single lump sum payment premium. And of course there's periodic payments. This is, more like how we're familiar with paying a lot of our bills, right? We pay little tiny payments, saving for retirement kind of thing, right? Putting little tiny bits away, saving up a little bit here, a little bit there, like we save for other retirement accounts, so that later on, when we're older, we can start taking those little checks out of the piggy bank for our retirement. Okay, immediate annuities. This is how you get paid, right? So immediate annuities is you're getting paid immediately. So immediate annuities start within 1 year of the date of purchase, usually within 1 month. Keep that in mind. This is probably the question. Immediate annuities start within 1 year of the date of purchase. If you are keeping index cards, you probably want to write that one down. I will almost guarantee that is one of the annuity questions, that an immediate annuity starts within 1 year of the date of purchase. If there's anything on timing, that is probably the question. The most common immediate annuity is known as a single premium immediate annuity. One lump sum starts paying an immediate annuity. SPIA, single premium immediate annuity. Deferred annuities. This obviously is not within 1 year. Deferred annuities. Income payments start sometime after 1 year of the date of purchase, sometimes many, many years later. So after 1 year of date of purchase, I think the question is actually going to be on the other one, but just keep in mind deferred annuities after 1 year of date of purchase. Payout options. This is once we've annuitized, how we're going to get the money. Straight life. This is also known as pure life. I would know life only. Straight life provides income for the annuitant's lifetime and only for their lifetime. It stops upon their death. No beneficiary payout. If you die before using up all of your money, the insurance company keep it. But know that this has the highest monthly payout. I think that will be one of your questions. Straight life has the highest monthly payout, but it ceases when the annuitant dies. So it's the most risky, right? That's why it has the highest monthly payout. But know that it does have the highest monthly payout because I think it's a really highly testable question. That one is almost guaranteed to be a test question. That is a very, very highly testable one. So make sure you know pure life, straight life is the highest monthly payout. A little less risky, life with period certain. This one is you guaranteed payments for a specific period of time, example 10 or 20 years, or the annuitant's lifetime, whichever is longer. If the annuitant dies within the period, payment continues to the beneficiary. So this one, for example, grandpa gets life with period certain, 20 years. If he dies after 15 years, his beneficiary would get the extra 5 years of the period certain. Some of the other types of annuity payout options that there are fixed amount, pays a specified amount basically until your funds are depleted. Then it will pay your beneficiary if you die before your funds run out. Joint and survivor, this is usually for married people. Payments continue to the survivor after the first person dies, usually at a reduced rate. Life with refund option. This ensures that the annuitant or your beneficiary receives at least the total principal that you invested if you die early. I'm not sure these will be testable. Know them because they might be. I think the biggest test question is going to be straight life. I almost guarantee that will be on there. You may see one of these too, but straight life, I'm guaranteeing it's going to be on there. It's a straight life question. So make sure you know that one cold. And thanks for joining us. As always, remember straight life. Anything variable requires dual licensing. And I appreciate all of you coming to join me again in another episode of Insurance Test Help. If you have any questions about the annuities in this or any of my stuff, please be sure to hit me in the comments. I want you to pass first time out the gate. And if you did pass, be sure to let me know. I love hearing about it. It totally makes my day every time one of you pass. It's like totally makes my day going off to my job at my insurance job. Thank you so much for making me part of your insurance journey. Have a great day. Bye.